to 𝗥𝗵𝗲 show. Thank you for always tuning in week in and week out to listen, learn, and grow. And we truly appreciate you for taking out your valuable time, because time is money and you are here with us. So we always want to impart so much knowledge to you. And my co-host, Ria, is taking over the conversation today. So before I do bring her on, I just want to introduce myself. My name is 𝗥𝗵𝗲 and welcome.
My name is Ria and
welcome
to our show. Topic is from the book of Robert Kiyosaki, Increase Our Financial IQ. And today's topic is internal rate of return, or IRR. So I'm going to be sharing about 7 lessons learned from this topic. First, internal rate of return, or IRR, is one of the more complex, sophisticated, and often confusing measures of return of the investment, or ROI. Second, if investors really know what they are doing, they can increase their ROI, or return of investment, by understanding the IRR, or internal rate of return. So if I'm an investor, it is very important that I need to know what internal rate of return is, or IRR. Now, I'm going to share with you this, which I shared before from the book of Robert Kiyosaki. So we have an income statement. And anytime we have an income statement, we have to do a balance sheet. They all need to add up. So with the income statement, we have the income column and we have the expenses column. Under the income column, on the topic of IRR, or internal rate of return, income column has the passive income. Now, under the expense column, we have the depreciation for the internal rate of return. Now, on the balance sheet, as we remember, the balance sheet contains assets, the asset column, and contains the liabilities. Now, when we talk about internal rate of return, assets on the internal rate of return means your appreciation, and the liabilities for the internal rate of return, it's called amortization. So I'm going to be using this table a lot when I explain more on internal rate of return. The third lesson I learned is, in overly simplified terms, IRR, or internal rate of return, measures other returns and other leverage that a well-controlled investment can provide. So it talks about other returns and other leverage. Now, fourth, this is now going deeply into the internal rate of return, income statement, and balance sheet. Now, if we remember, on the income column, we have the passive income. So going back, we have this. This is the income statement. We have the income, and we're going to be discussing passive income. So again, income statement, under the income column, we have the passive income. So for internal rate of return, we understand that the gross rents, okay, gross rents meaning all the rents without any deduction of all our expenses, they're all gross first. Gross rents are part of the income column. Okay, they are part of the income column. Yet, internal rate of return, or IRR, also measures other forms of income. Now, passive income is subject to a lower tax than earned income. So earned income is the income we get when we are employed, right? When we are employees. And in America, we get a W-2. If we get W-2, meaning we are employees, and that means our money is coming from earned income. So then that means if we have W-2 or we are employees, that means we do have high tax. So let's compare that to the passive income. Passive income is subject to a lower tax than the money we get when we earn the money working as an employee. Now in the USA, passive income, it is not subject to Social Security tax or self-employment tax. What does it mean by it is not subject to? So when we have passive income, the Social Security tax is not deducted, the self-employment tax is not deducted. So that means we have more money into our pocket. Now, in other words, these taxes, Social Security and the self-employment tax, do not show up as an expense in the expense column. Okay, that means we have more money in our pocket. It does not show up in the expense column, the Social Security tax and the self-employment tax. When we talk about passive income, which is technically a gain in income, we have more money in our pocket when we talk of passive income. Okay, now fifth lesson, expense column, which is the depreciation. Now again, this is our income statement. We're going to discuss on the expense column and on internal rate of return. This is the depreciation. So in the USA, the tax department gives some investors an additional income. So more income, additional income that actually looks like an expense. So it looks like an expense, but it is an additional income to the investors. Now, this income is known as depreciation. Depreciation. Another term for depreciation is called phantom income. And you may ask, why is it called phantom income? Depreciation, also known as phantom income. So the reason it is phantom income is it's income that shows up somewhere else. It is income that shows up somewhere else. And so that's the reason why it's called phantom income. Now let's give an example. So for example, my tax bill is $1,000. Okay, I have a tax that I need to pay $1,000. The IRS may allow me to depreciate my investment. Depreciate, okay, depreciate. By depreciating, I get phantom income. Depreciate my investment by $200, allowing me to pay only $800 in taxes. This $200 then is my phantom income. Okay, phantom income, income that I do not see, income that shows somewhere else. So this additional $200 is the phantom income, or money I do not have to pay taxes, right? So it's this $200 that remains in the pocket, in my pocket, in your pocket, instead of going to the government, because of the word called depreciation. So depreciation, okay, phantom income. So depreciation, we depreciate. What's the opposite of depreciate? Is appreciation. Appreciation means your value goes down. Depreciation means your value goes down, okay? Appreciation, it goes up. Depreciation means it goes down. So depreciation, when you're an investor, just like myself, I'm an investor in 2 apartments, which I rent out to my tenants. Depreciation is allowed for things inside the building, such as refrigerators, ceiling fans, carpets, furnitures, and items that decline in value with age. My CPA can explain this to me if I own a business, if I own real estate. Now, if I'm an employee, I cannot get this depreciation. I can only get it when I own a business or I own a real estate. And this is where you need your CPA, your team. Your team member, one of your team member is a certified public accountant or a CPA. So there is no such thing as depreciation for paper asset investors. And there's no such thing for depreciation too if you're an employee. There's such a thing for depreciation, again, if you have a business and you own real estate which you rent out. It has to be a business. It cannot be a hobby. The sixth lesson, liability column, which is the amortization. Again, we go back to the income statement. You have the income and the expense, the balance sheet, which you have the assets and the liabilities. And now we're going to talk on the liability column, which is amortization. Amortization when we talk about IRR, or internal rate of return. So another form of income to investors is known as amortization. Okay, you have to remember it's an investor and it's another form of income. So these are the key words: another income for investors, also known as amortization. Amortization is a fancy word for paying off debt on a scheduled basis. So in America, we have 30-year amortization. So that means I can pay down my loan for 30 years, and it's on a scheduled basis, either every 2 weeks, every month. But every month I have to pay my mortgage, or principal and interest, right? Your P&I to the bank on a scheduled basis. So here is an example of an amortization schedule. Like again, amortization is a fancy word for paying off debt on a scheduled basis. So this is the schedule. So it's called schedule, okay? So this is paying down your debt. With debt, we have the principal and we have the interest, okay? And this is the outstanding balance remaining. So if you see here, it starts from February 2013, March, April, May, June, July, August, all the way down to 2014 and so on. So that's why it's called a schedule. So every month, the bank automatically takes out payment called mortgage, which is a breakdown of your principal and interest. So that's what is called amortization. It's a scheduled payment of your debt. Now, when I have a good debt, that means my tenant pays for my debt that someone else pays for me, then amortization becomes income to me. In other words, as tenant pays down the debt, that payment is technically income to me. Income that is paid to reduce my debt as much as my cash stays in my pocket. Now, what you do with the cash that stays in your pocket, now you're ready to deploy that money for the next great investment opportunity. While my tenant continues to pay down my debt, I still receive all the tax benefits associated with my investment. And I would also add, while my tenant, right, my tenant pays my debt, and remember, this is 20% loan to value, okay, loan to value. So that means I only paid 20% out of my own pocket. And the 80% is from the bank. So the bank does not get the tax benefit. The bank does not get the tax benefit. Even though the bank contributed 80% of the money, I get all 100% of the tax benefit, including the depreciation, the amortization, all the things that I discussed earlier. I get all the tax benefit associated with my investment. Seventh lesson. Now we're talking about the asset column. So when we talk of internal rate of return, we talk about appreciation. Again, income statement, you have the income and the expense, balance sheet, you have your assets and your liabilities. Now we're going to talk on this asset column, which for internal rate of return, we are talking about referring to appreciation. Appreciation means, this is the opposite, the contrast of depreciation. Appreciation is an increase in asset value. This is also income to me. Okay, appreciation is also income to me. Now, this, when you have big properties such as Robert Kiyosaki in the hundreds, in the thousands, now when they talk about appreciation, this is not appreciation based upon some appraiser's idea. Okay, this is not based on some appraiser's idea of an increase in the sale price based on comparative sales in the area. So what this means is that if you have 100 apartments, 200 apartments, 1,000 apartments, the appreciation is not based on the comparables. It is not based on the appraiser's value of your property. The way Robert measure appreciation is, or if you have, hundreds of apartments, it is not based on the comparables, but it is based on the actual increase in income to your property's income column, or to Robert's income column, or to my income column. So for example, the increase of the 360,000 in income, and this 360,000 is from other incomes. If you remember from the previous recording, if you cannot, then go back and review. But this $360 was just, for example, an increase in the rent, right, of $25 per month. Why? Because either you provided, you changed it to a granite countertop, or you added washer and dryer, right? So that's why you were able to increase the rent. So just by increasing the rent, and this is not including the other income, this is just by increasing the rent, you were able to get 360,000 of other income, okay, from Robert's 300 apartment units, which is measurable. So Robert is saying that when we talk about internal rate of return, this is not an exact method for defining the internal rate of return, but it gives us an idea of how an investor can increase the rate of return far higher than most investors can receive from paper assets. Because there are several things, and these are just some basic, simple things that Robert explained in the book when he talked about internal rate of return. Because with income, right, you have the passive income. With the expenses, you have the depreciation. With assets, you have the appreciation. With liabilities, you have the depreciation. So I hope you learned something. Let me know in the comment section below what you learned from today's topic of internal rate of return. This is just a simplified explanation of the internal rate of return. If you want to know more, like I said earlier, internal rate of return is complicated. There's so many variables, so many factors that you have to consider. Tune for more of Alka and Ria's show. Let me know in the comment section below your #1 key takeaway from today's topic.
Yeah, Ria, you know what? I guess the basics is also understanding the balance sheet. Understanding what's your asset, the liabilities, and I guess once we learn to, understand that as a basics, I think that's what we need to do, right? Understand what's your assets, what's your liabilities, and then figure out the numbers from there.
That is correct, because as time goes by, as we have more information, it gets more confusing. Now, that's why you have to continue reading. And, just like ourselves, we have several mentors. We just don't end with one mentor. We have Grant Cardone, we have Robert Kiyosaki, and I do have other mentors as well. So when you are confused, when I am confused, I know that I do not understand it well. So that means I've got to dig more about the topic. So what I've provided to you is just a simple explanation of internal rate of return, but there are more things that we need to learn when we talk about internal rate of return. But yes, understanding the basic is a key principle in life.
Exactly. Understand the basics, and I think then you should be fine. Just understand the basics, the fundamentals. So, Ria, thank you for sharing. Truly appreciate, and thank you for tuning in, everyone. Really appreciate your time. Hope that you really got some nuggets from what's been shared today. But thank you for, we hope that you really have an amazing rest of the week, have a great success. And as I always say, knowledge is power. Knowledge is just one half, but you need to implement. So go and implement what you've learned, and we will see you same time, same place tomorrow morning.